What's up, BiggerPockets? This is Alex. Again, I'm here today. I'm going to talk to you about the 5 C's of credit. These are the underlying decision metrics that lenders use to decide if they want to give you money or not. The 5 C's of credit are character, capacity, capital, collateral, and conditions. This is a fairly ubiquitous framework that lenders use across all various different types of lending. But today I'm going to talk to you specifically about institutional residential loan mortgages. I have been working in lending for 15 years, auto lending. I did credit cards. I've done small personal retail loans, and now I do commercial business banking. This is an underrepresented viewpoint perspective on BiggerPockets, and I wanted to provide a little bit of that, of my experience and knowledge to help you figure out getting loans a little bit easier. People ask me about lending all the time, and I'm actually, no offense, surprised how big the disconnect between what people know how banks work and how they really work is. So I wanted to provide a little perspective, and I really wanted to, give some people some insight so that most of the time people just get in their own way, and I'm great at helping you get out of your way. While it's important to know that all banks are different, and they certainly are, they all do follow this underlying decision metric, the 5 C's of credit. Just like restaurants all serve food, but P.F. Chang's and Chick-fil-A are very different. They're both delicious, but you're gonna get something different when you walk in each of them. This video is not a comprehensive guide to all underwriting. So if I leave something out or I skim over something, please know, don't message me hate mail telling me that I missed something. I know. I just want to provide some perspective so that you can get paid easier. The first is character. That's you, baby. So when you go to the bank, try to pretend like you're a charming and responsible adult. The bank wants to feel very confident in your ability to repay. More so than just if the deal makes sense, they want to feel confident in you, your competency, and your ability to handle the loan. Track record matters. Sell it. And I don't mean, if it's your first deal, I don't mean that you have to have some track record to get a loan, but you should be able to sell your experience and your story in a way that is applicable for the loan in question. To be fair, character used to be a much bigger part of the credit approval process, but these days we have this magical new thing called the FICO credit score. I know that there are creative ways to get financing outside of institutional banking, so if you have bad credit, it's not the end of the world, but if you do have bad credit, I urge you to work on it so that you do have access to these institutional lenders. The ideal candidate is going to have a good credit score, they're going to have a decent track record, and they're going to have a skill set applicable towards the type of loan that they're trying to get. Number 2 is capacity. This is your ability to repay the loan. We don't work on the honor system, yo. You need financials. If you're buying residential mortgages, this is actually quite simple. It's going to come down to DTI, debt to income. That's your income minus your debt. In addition to can you pay the debt service, they're going to ask you probably for a personal financial statement. This is a good practice for most people to do if you've never gone to a bank, if you've never seen a personal financial statement. It's basically just a balance sheet, your assets minus your liabilities, plus it's going to ask you about income, and you're going to fill it out yourself. This is extremely standard, so if you've never seen one, grab one, check it out, go over it before the bank gives it to you, and if anything, but when you go to the bank, have it filled out. For non-government backed debt or loans that are not based on your DTI, they're gonna go by 2 years of your tax returns, 2 years of your tax returns, and they're gonna go by DSCR, that's debt service coverage ratio. That means, can the cash flow of the asset pay for the loan in question by 1.2 times the debt service? If you do want to maximize your DTI, which I highly recommend, it makes it much easier for lending, then all you have to do is increase your income and decrease your debt. Super easy, right? For my friends who do the Burr method, which I love, one tip that I cannot stress enough is to go to your lender before you buy the house and talk to them about the refinance on the back end. The number one email I get is people who have bought a house, they rehabbed it, they put a tenant in it, and now they can't refinance for something they didn't account for in the first place. Talk to the lender before you buy. Number 3 is capital. That's your liquid capital injection and any reserves you have on hand. BiggerPockets members, this is specifically for you, and I want you to listen up because I know you're gonna hate hearing it, but it's gotta be said. I know that it's super in vogue to buy real estate with low and no money down, but I assure you, banks hate you for it. Sorry, Brandon. The bank wants you to have equity for risk mitigation purposes. It makes it easier for them to liquidate when you default. And they want you to have skin in the game, yo. In addition, you should want equity. I know it's popular to over leverage everything right now just to feed your sick little ego so you can go out, buy something, and put it online and brag about it. But equity is your risk mitigation, man. It's your buffer. It's not so bad to have 75% LTV. I work in risk mitigation for a living, so maybe I'm biased, but I want you to think about it from the bank's perspective. The bank thinks in terms of low risk. You know who's a high risk? Somebody who has high debt, high leverage, and no cash reserves. One of, if not the biggest reason that businesses fail is because of undercapitalization. Don't go in too light, man. Liquid capital injection, cash reserves. Make sure you have some. Number 4 is collateral. Collateral is probably the most important part for this video because most people who watch this are going to be buying residential mortgages, and the collateral is the asset that you fix that loan to. Bankers love collateral because it gives us something to sell after you default. Trust me that liquidations are not fun, but they happen. So while it might be annoying to fit into the strict bank parameters, I'm gonna be super happy that I only own that house for 75% when the dust settles. Nobody wants to default. You don't want to default. I don't want you to default. No banks ever want anybody to default, but it happens. Fact is, the better the collateral, the better the loan. The lower risk the collateral is, the better rate and terms you get. The reason why unsecured on-demand credit, like credit cards, are expensive is because the risk is high. And the reason a 30-year government-backed mortgage, the rates are so low is because the risk is so low. Better the collateral, better the loan. 5th one is conditions. This is the loan terms that go along with the deal. For residential fixed rate mortgages, it's simple. It's how long and what's the rate. If you go to non-government backed loans or an in-house portfolio lender, then the conditions can be infinite because the variables on a commercial loan are infinite. But for the most part, if you're doing FHA, Fannie, Freddie, any of these standard mortgages, the terms are gonna be extremely simple, and to be honest, conditions isn't something you're gonna have to worry about much. Okay, those are the 5 C's of credit. That's character, capital, capacity, conditions, and collateral. I said them in the wrong order. But it's not a complete list of everything you need to know about bank underwriting, but it is a start. And if you have these in mind when you go to talk to the bank, you should be able to design your strategy a little bit better. The reason I think this is important is because most people go to the bank and they try to sell the bank on why they're a good risk based on what they think is important. And that's backwards, because the bank doesn't care about any of the things that you think are important. The bank has a whole slew of other things that they think are important. They make credit decisions on things you're probably not even thinking about. The 5 C's may be one of them. So I hope that this gives you a little bit of insight on how we do business, so that when you go there, you can stop thinking about why you're such a good risk because of what you think is important, and you can start thinking about what they think is important. Thank you for watching another one of my videos. I'm very grateful. My name is Alex. I'm going to be on the BiggerPockets forums. If you want to ask questions about this video, I'll be in the blog that you can put comments in the blog post, and I'll be on the YouTube. I'll answer everybody's questions. Thank you so much. Stay tuned for the next one.